Hey everybody, welcome back to Money Made Simple. If you're new here, my name is Micah, and on this channel, we talk about all things budgeting, saving, and investing in a simple but practical way. Today's video is something that I've been looking forward to doing for a very long time. I'm going to be giving you an inside look at my actual investment portfolio, which is held within Wealth Simple. I'm going to be showing you guys exactly what accounts I have, what I'm invested into, and just exactly how everything has been performing so far. I'm hoping to make this a long-term series where we can just kind of go through on a weekly basis and just see what exactly my portfolio looks like. And it's all about just being transparent and kind of giving you guys insight on what long-term investing actually looks like in action. So without wasting any more time, let's get into it. This is my Wealth Simple portfolio. So as you can see here, my portfolio value is currently sitting at around $67,523. Now, this is split up across many different accounts, and I'm going to kind of go through the accounts first, and then we can go into the accounts and look at what I'm actually invested into and how I've chosen to separate things. So first things first, and this is the most important, by far the most important thing that I have, and you should have, is an emergency savings or an emergency fund. Now, my emergency savings is currently just under 3 months of savings. So that means if I were to break my leg and I can't work, or something happens and I'm not making any income, I can sustain myself for 3 months and hopefully find another way to make money, or if I lose my job, I can get another job. It just gives me 3 months of buffer room, which really all it does is just give me peace of mind, really. That's what it comes down to. That's what your emergency fund is supposed to do. It's supposed to give you peace of mind. So that's what I have here. I am working on building that up just a little bit more. I need to get up to 4,800, and that will be 3 months of savings for me, and then I'll be covered. You obviously can go more. You can go 3 to 6 months, or if you're a little bit later on in life and you have a mortgage on all these things, you might want to actually increase that to like 6 to 8 months. Some people even go as high as a year. All kind of depends on your finances, where you're at, what your budget looks like. But for me, for my stage of life, I'm comfortable with sitting at around 3 months, and over time, I'm going to continue to build that. Another thing to note about that emergency fund is it's just sitting in Wealthsimple's cash account, which is essentially, it's not invested into anything. It's really just a high interest savings account, no different than your typical banks. The only thing that's different is Wealthsimple offers a bit of a higher interest than your typical banks. Wealthsimple right now is offering a 1.25% interest rate on their cash account, whereas your typical bank, honestly, most of them are less than 1%. So it might not seem like the biggest difference, but over time, even a 0.5% difference can really change the growth of your money. Especially if your emergency fund is like over 10 grand, or the more money you have in it, the more that 0.5% really makes a difference. So that's why I've chosen to have it there. It's also very liquid. I don't have to sell any positions in stocks that I own. I can just directly e-transfer it right into my bank account, and I can get that money in about 10 minutes. So that's why I've chosen to do it that way. And then next I have banked hours. This one you don't really need. My work offers a banked hours thing that they do, where anything over 40 hours, they can hold that money for you. And that way, if you take a sick day at work, they'll pay you for that day out of your banked hours, if that makes sense. I've just chosen to do that myself. So any money that I make over 40 hours in the work week, I put it into this account, because really all that my company is doing is they're holding your money, everything you make after 40 hours, and they're just holding it in a high interest savings account. They're making interest on that money, and then when you want the money, they just send it to you, but they've already made interest on it. So it's just a way for them to make more money. So I'm like, well, why don't I just do that myself? I'll take the extra interest. So I've chosen to do that. And again, I just hold that in a cash account with Wealthsimple. That way the money is liquid. It can come to me within 10 minutes if I need it. Okay, then the biggest one that I have is my TFSA, my tax-free savings account. In that account, I have about $41,782. Next up on the list is my FHSA, which is a first home savings account. You can only use this money on the purchase of your first home. If at some point in your life you realize, I'm actually never going to own a home, maybe I'll never be able to afford it, or maybe I actually just choose to rent, I don't want the stress of owning a home, then you can take whatever money you have in here and transfer it into your RRSP. But you're very limited with what you can do with this account. So I have the hope of owning a home one day, so I'm kind of prioritizing this account. There's also a lot of great tax benefits with it. But today I'm not really going to be going into what these accounts do or what they are. I'll make a separate video on that where it's kind of going through the accounts that I have and what's in them today. So next up is my RRSP. That currently sits at around $6,888. Now that one you'll see here is the same as my FHSA in the sense that they're both managed, which means I actually don't go in and choose the stocks that I'm buying. I set them at a risk rating. You can set it from 1 to 10, 10 being super risky, 1 being very conservative. So I have set those to their corresponding risk ratings, but we can go through that later. Just thought it was important to note now that those accounts are managed by Wealthsimple, not myself. Okay, then next I have a non-registered account, which sits at around $97. You will see that account is doing horrendously. That account for me is honestly kind of like a gambling account. I only hold one stock in there, and it's just a stock that I wanted to try out, and I just wanted to see. It might take off, it might plummet. So far it's been plummeting. I honestly don't have hopes of it going anywhere, but I didn't put too much money into it. It's money that I'm happy to lose. I have a lot of money in other places, and I could afford to lose the money that I put in there. The whole idea is that I'm not putting money that I'm counting on for my future in this account. This was just kind of a one-off. I wanted to try this stock. I wouldn't recommend doing that. It's a risky game. That's not normally how I invest, so don't take that as investing advice. Just stay away from it. Next, I have a kids fund, which is sitting at about $676. I am years and years away from ever having a kid, so I'm not really prioritizing this account. That's why there's not much in there. But I did want to get started early, so that when I do have a kid, I have a nice little bit of money there to kind of help me, because kids are expensive. And then last but not least, I'm sure you'll see here, maybe a bit of a controversial one, but I have a crypto account. I don't continue to put any money in here. What I've invested in there kind of just sits there, and if it takes off, it takes off. If it doesn't, it doesn't. I don't really care. Again, it was kind of money that I was willing to lose. I'm not going to be too upset if it goes to zero. But I do have a crypto account. I made that a long time ago, and I just decided, you know what, I'm not really going to sell it. I'm just going to kind of let it do what it wants to do. And if one day it goes to the moon, awesome. And if it doesn't, I'm not going to be heartbroken about it. So those are all of my accounts. All of those together give us our grand total of about $67,500. That's where we sit today. So let's just go into this. We already went through the emergency savings and the banked hours. Those are just like a high interest savings account, so there's really nothing to look into there. But if we go into my TFSA, this is where the bulk of my Wealthsimple account is. You can see available to trade. I have $73 in there. That means I have $73 to buy stocks with. All the other money that's in here is currently invested into stocks or ETFs. And so if we scroll down here, we'll see we have Apple. My position on Apple, this is the Canadian hedged version, just because I like buying Canadian hedged versions of US stocks, especially if they give dividends. Because if you buy a US stock that's not Canadian hedged, you do get a 13% withholding tax from Wealthsimple. They'll withhold that from you on all dividends. So if you're going to be buying a dividend stock that's American and you live in Canada, I'd highly recommend searching for a Canadian hedged version of that. That way you're not going to be getting taxed on the dividends, but that's just a little thing. So I own just over 15 shares worth about almost $600, and I'm up about 33% on that position. They give a very small dividend of about 0.37% on a yearly basis. So that is my position on Apple. Next, we have Amazon. Amazon sitting around $27, doing fairly well recently. I have 23 shares at about $624, and I am up 20.5% on that all time. Next, we have Bell Canada, which this one is crushing me, but that is okay. We're going to continue to hold it and just see what happens. You can see their 1 year and their 5 year here is just not great at all. They do give a very good dividend at about almost 9%, which is extremely rare. But again, I'm down 40% on that. I've lost about $226. I have 10 shares. I put in 565 and I only have about 339 there in value. So that is my Bell position. I don't really buy any more Bell, but I do let the dividends kind of reinvest, and that brings my average cost of buying down a little bit, which helps. Next, we got BMO. You're gonna tell very quickly that I am very into the big banks of Canada. I believe they're strong positions to hold. Just like you'll see here with Bank of Montreal, you can see how well they've been performing recently. Just in the past year or so, they've really taken off. They give a good dividend, 3.64%, which can't complain. And I'm up about 28% on that, which is really good. I don't have too many shares because it's a pretty expensive stock, but definitely worth looking into. Next, we have Bank of Nova Scotia, kind of a similar story with these guys. You can see recently they've taken back off. They've gotten to a new high. They give a 4.5% dividend, which is really nice. You can see here we're up 33%. That is about 2.73% of my overall portfolio. Again, just another strong bank position to have in here. Next, this one, again, maybe a little controversial. I own a Bitcoin ETF. This one is down a little bit recently just because Bitcoin has fallen. This pretty closely, almost identically tracks the price of Bitcoin. So as Bitcoin increases, this increases in the corresponding amount that Bitcoin does. Likewise, when it falls, this falls as well, which is why you've seen that recent dip. But they give a 14.13% dividend, which is insane. So I do like it for that. I also like it just for diversification's sake. I'm not really putting a lot of stake into crypto. As you can see, it's 1.14% of my account, which is really nothing when you think about it. If this falls to zero, I'm hardly even going to notice that across my entire portfolio. So I'm not really putting too many eggs in the basket of crypto here. But I do think it's good for diversification's sake. Because again, at this point in time, maybe earlier on you could have made an argument against it. But I think at this point in time, it's pretty clear that crypto is just another form of diversification. And I don't think that there's any harm in having a small chunk of your portfolio allocated to crypto. I think it's actually a wise move at this point in time just to diversify your portfolio, but not really putting too much stake in it, if that makes sense. So moving on from that, we have cash account. Not cash account, cash ETF. This one, it looks crazy if you look at it. But if you look at the price over 5 years, it actually doesn't really change. It goes anywhere from about $50 to $50.15, or maybe up to $15.20, and then it falls back down to $50. It doesn't really change. It's not meant to change. It's supposed to stay at $50. So you're never really going to increase or decrease in terms of your overall position on it. But it does give a 2.92% dividend, which is great because this kind of outperforms Wealthsimple's cash account, which gives you a 1.25% dividend. So really, you're just increasing your interest that you're making compared to a cash account. But I only like to keep my position in this ETF at about 3% of my portfolio. Again, it's just kind of an extra fail-safe and a little bit of, peace of mind of knowing that, worst case scenario, I do have this stock, which is about 3% of my account. And if I need to one day, I need some extra cash for maybe I need a new car or maybe a car repair or something like that, then I know that I have this. And so that's why I try to keep it around 3% of my account, because it doesn't really make a lot of money. It does give you dividends. So it's a good place to park your money in the meantime, but it's also a great ETF to put your money if you're going to need it within the near future. So that's kind of what I have it there for, just so 3% of my account can be cash, essentially. Then I have Canadian Railway, which is a new position. I'm still kind of considering how much I want to put into this, but as of now, I have just over 2 shares. They have a 2.62% dividend. and I'm currently down about 1.7%. As I said, it's a relatively new buy because of the massive dip that it's seen. I figured, why not get into it? And then moving on from there, we have Canadian Tire, which has just been an absolute powerhouse of a stock, especially dividend wise. They've increased their dividend every single year for the past like 50 years or something crazy like that. So Canadian Tire, definitely a strong buy. They're 4.18% dividend. I'm up about 7%. Nothing crazy, but I do have high hopes for Canadian Tire. I think it's a great stock to own. Good blue chip company. Can't really go wrong in my opinion. Now, probably my favorite stock here is Enbridge. Enbridge is a true powerhouse of a stock. I absolutely love Enbridge. I recommend it to everybody, and everybody I've recommended it to loves it because, well, look at it. I mean, like, it's just crazy. Like, they just persevere through every downturn. They don't stay down for very long. Like, you can see they had quite a big downturn here, but didn't last longer than a year before they just absolutely started skyrocketing. So I love Enbridge. They give a very healthy dividend of 5.55%. That goes up and down, but right now that's where they're sitting. You can see I'm up 33% all time, and it's about 5.5% of my portfolio. Okay, next I have an Ethereum stock, ETF rather. This is very similar to the Bitcoin one, but again, if you look down here, it's 1.04% of my portfolio. So again, I'm not really allocating more than 2%, 2 to 3% max of my portfolio into crypto. I'm not putting too many of my eggs in the basket of crypto. That's not what I want to do. I just want to use it as a small form of diversification, just so I have something and it helps kind of spread my portfolio out a little bit broader. So that's what that is. Has a 16% dividend, really nice. Again, I don't really buy too much more of that position. I just kind of let those dividends reinvest themselves, and it does most of the work for me. Next here we have Home Depot, which just kind of fell down recently. You can see here, but they give almost a 2% dividend every year, and I'm up about 70%. It's almost 2% of my account. Probably looking to buy a little bit more of this, especially with this recent downturn, because it was doing fairly well before I made this video. Actually about a year ago, they were almost up to $28, which is pretty good, and they almost came back up to that, reaching just under 27. So probably going to want to put a little bit more into Home Depot there. Again, that's also Canadian hedged because they give a dividend, and I don't want to have that 13% withholding tax on those dividends. So that's why my position is sitting there in that Canadian hedged version. Next, we have HTA. This is a tech ETF. They give a very high dividend here. You'll see, where is it? 9.61%, crazy dividend. I'm up almost 10% in total, and that is about 1.4% of my account. Maybe looking to buy a little bit more of this as well, just because I am very bullish on tech. I think tech's a very good sector, so I might want to get a little bit more invested into that. But that kind of leads us into our next one, Meta. I think Meta is also held within the HTA ETF. But Meta, I absolutely love. I bought Meta when it fell down to like $120. This is the Canadian hedged version because they now give a dividend. So I want to be in the Canadian hedged version so I don't get that withholding tax. But they've also had like a 12-13% drop here recently. They were up to almost $43 and they're down about $9 from that. So you can see their dividend is very low, but that's because they just started giving out that dividend. So I have hopes that that's going to increase. But I'm only holding about 1.17% of that in my account. So not too much, but it is a fun stock to have. It has done very well recently. So I like Meta. Not too much more to say on it. But this one's crazy. This has been by far probably my biggest stock that has performed well. It's Manulife Financial. I mean, just look at that. Look at the 5-year. Like, crazy. There's really no big downturn at all. Like, if you want to talk about buying opportunities and looking for a stock to go on sale, so to speak, you don't really get many opportunities with Manulife, to be honest. They give a 3.5% dividend, and I'm up 80% all time, which is just crazy. It's 3.41% of my account, and I'm up $634. I absolutely love this stock. I'm hoping, you don't hear people say this a lot, but I'm hoping this price falls soon so I can buy more. I do continually invest into it. Like you can see, I let the dividends reinvest themselves, but I would love to increase my position even more if this stock does drop. I will definitely be looking to buy more of that. Nvidia, very popular stock recently, very big in the tech sector. They give a 0.02% dividend, which is next to nothing. But I love Nvidia anyways. They are a powerhouse of a stock. I'm up about 55% all time. And I mean, you just talk to anybody, you research it anywhere, and Nvidia is just unstoppable. It's reached all-time highs every month, and whenever it reaches a new all-time high, people are like, well, it can't keep going, and then it does. It kind of like Bitcoin. Bitcoin reached 50,000 years and years and years ago, and people were like, oh, you're too late on it. Don't even bother. And now, we just recently saw Bitcoin hit 170,000. So Nvidia is kind of a similar story. It just doesn't stop growing. So I don't have too much of it. I have about $338 that I've bought, which is now worth is now worth $523. So definitely a strong position there in Nvidia. Moving on, again, I told you I'm heavy into the banks. We got RBC doing incredibly well recently. You can see here they gave a 2.79% dividend, which is pretty good for a bank. Not too bad. I'm up about almost 53%, which is pretty crazy for RBC here, but they're only about 2.74% of my account. Their stock price is getting pretty pricey to be able to buy a full stock. I still have from time to time, but probably going forward, I'm probably just going to be buying fractional shares of that. But yeah, that is my position on RBC. Next, we have TELUS. Man, the telecommunications sector has not been doing great. As you can tell, it's pretty much a similar graph to Bell's. Again, same story with Bell. I'm not really investing into this one. I'm just kind of letting their dividends, a 9% dividend, kind of do its thing and reinvest itself for me. I'm down 34%. I've lost more money than I want to talk about on that position. But again, I do want to be invested into the telecommunications sector because it's just more diversity. But that just goes to show the importance of having a diverse portfolio. Is when the telecommunications sector is not doing good, the finance sector is doing good. And when the finance sector is not doing good, the tech sector is doing good. When the tech sector is not doing good, the healthcare sector is doing good. That's just the importance of being diversified. So everything kind of balances each other out, and it mitigates those really high of highs and lows of lows. So that's kind of why I am still invested into the telecommunications sector, even though they're doing bad. I just want that diversification. Going forward, I have TD, another stock that I've heavily recommended to some of the people that I've gotten started on Wealthsimple. This stock has grown tremendously recently, and I unfortunately bought it way back here, and then it just continued to fall, and I was a mess. I was like, this has to take off at some point, and I kept buying consistently, and thank goodness I did, because now we're sitting at, I've made about $450 off of it, up about almost 37%. Just a great stock, giving 3.5% dividend. Again, it's in the finance sector, a sector that I love. So definitely one of my more favorite positions that I have. Then I have VDY. This is a Canadian high dividend yield ETF. I like this one too. I was also kind of similar. I was stuck kind of like TD in this area where it wasn't really growing, and I was getting kind of frustrated. But again, I just held long term. And then you see here, we have this massive growth over about the past year or so. So I'm very happy with that, giving a 3.65% dividend and currently about 8.9% of my portfolio. Definitely a heavier position that I own, but I'm up about 36% on it, almost $1,000 return all time. So I'm very happy with that. Next, we have VFE. This is your commonly referred to as S&P 500, the holy grail of investing. This is majority of what I own, as you're going to see as we scroll down here. They don't have a great dividend, 0.9%, but we are not in it for the dividend. We are in it for the growth. As you can see, it is consistent and reliable over the course of history. We're up about 47 or 46%, made almost $3,000 off of it, and our position is almost 23% of my account. So definitely one of the heavier, actually it is the heaviest position that I own, just in terms of overall percentage of my portfolio, because the S&P 500 is kind of the meat and potatoes of what I think any portfolio should be. That should be your meat and potatoes right there. So definitely highly recommend looking into that. There are other ETFs, or sorry, S&P 500 ETFs that you can look at. Doesn't have to be VFV. This is just the one that I'm invested into, but they all are the same thing pretty much. Next, we have VGROW. VGROW is a growth ETF. I'm pretty sure most of it are U.S. equities. I think there's a couple Canadian and maybe a few international, but I could be wrong, but I think like 70 to 80% of it is U.S. equities. But it's mainly meant for growth. The dividend isn't crazy. It's a 1.66% dividend, but decent growth over time. It's 22% of my portfolio. I'm up 24% almost all time, about $1,700. I just haven't held this one for as long. Otherwise, I probably would be up a little bit more than only 24%, but I didn't buy this one too long ago when I started, so the growth isn't as high, but also definitely a very worthwhile ETF to look into there, VGROW. Next, we have something that some would argue for somebody my age I don't actually need yet, but this is a bond ETF, iShares Core ETF. They give a 3.33% dividend, and you can see I'm up 1.84%. It's only 4% of my portfolio. I wouldn't put this any more than about 5% of my portfolio, just because it is bonds, and at my current age I don't really need bonds, because what bonds do are they're just another form of diversification. And so when the stocks and ETFs are doing really good and all your equity positions are doing good, bonds are kind of down here. But when that starts to take a turn and all your equities start to take a downturn, that's where bonds start to go up. So they kind of help level out your portfolio. And again, they lessen those highs of highs and the lows of lows, and they kind of bring you back to this median, kind of meet in the middle area. So that's why I have bonds. But again, the 5% max, because I don't really need them. I have enough years ahead of me that I'm going to be able to kind of ride through those highs and lows. Whereas if you're getting older and you know that you're kind of relying on the money in your portfolio within the near future, you might want a little bit more bonds just to kind of help keep you even closer to that middle. But for now, I don't really need it. I do like to have it though, so I just have it at about 4% for right now. Definitely not a bad idea, again, just for diversification's sake. Next, we have XIU, which is like an S&P 500, but for Canada, and it's the top 60, not the top 500. But you can see this is also doing very well. Not as strong of a position, only 1.24% of my account, but I am looking to increase that. I'm up about 20% on that, and it is giving a 2.42% dividend, so not too bad. And then last on the list here is ZRE. This is a REIT index ETF. This is pretty much real estate. This is the real estate market. You can see their dividend is very, very nice, 4.92%. It's a very healthy dividend. I'm up about 5% on this. Nothing crazy, but again, it's just getting me into another sector, making me more diversified. So yeah, that is my TFSA. A lot of positions. It's all going to change over time, but this is kind of what we're looking at right now. So yeah, that is, you can see this is the graph here for all time in my TFSA, looking pretty good. We're up about 36% or 11,000 all time. Moving down into my FHSA, this one, there's a lot less to go through. I'm just going to kind of show you guys what we have here. We're up about 18% all time. And this one, I can't actually, let me look here. Okay, so I can't find it, but somewhere in here, it will say what your risk level is. And I think I set my risk level to, oh, here it is. My risk level is 7 out of 10. I'm probably not planning on buying a home for the next 3 to 5 years, so I can kind of ride some highs and lows as we go through the highs and lows of the market. But probably within the next 2 to 3 years, I'm going to drop that risk level down to maybe a 5 or a 4, just to be a little bit more conservative, because I know I need to access that money relatively soon, whereas right now it's kind of further out in the future. So I have it at a 7 out of 10 to give it the chance to grow just a little bit more. That leads us into my RRSP, which this guy is 10 out of 10. In other words, I'm not going to be retiring until I'm 60, or at least I can't take this money out until I'm 60 anyways. So why not just put it at a 10 out of 10? I have so many years ahead of me to ride out all the highs and lows. There's no point. I might as well make this as aggressive as possible so I can get the most growth for as long as possible. And then as I approach the age of retirement, then I can slowly start to peel that back, and I can go from 10 out of 10 to 8 out of 10 to 6 out of 10. And, by the time you're hitting 50, 55, you should be at a 1 out of 10. And you should be getting a much higher position in your overall cash and bonds. Whereas right now, there's really no need for that. And the management fees on these are next to nothing. It's 0.5%. I'm more than happy to have a 0.5% management fee if it just kind of lessens the overall stress of having to choose what I invest into. My TFSA has more than enough for me to focus on, so I'm happy to have my FHSA and my RRSP managed, as well as my kids fund. My kids fund, I haven't even looked at in a while. It is at an 8 out of 10 risk level, just because, again, I don't plan on having kids for a long time, so I'm able to kind of make it a little bit more risky. And again, when I get married and when I start talking about having kids, then I'm going to start to peel that risk level back. We're not really going to go into the non-registered because I don't really even consider that to be like an investing account. It's more of just like my fun account. But next year we have crypto, which again I haven't touched in a while, but we have seen some good growth on it. I have a bit of Bitcoin, a bit of Ethereum, and a little bit of Solana. I don't know why. I just felt like to buy Solana one day, and I just did. It was kind of an impulsive purchase, and I shouldn't have because I'm down on it. But Bitcoin and Ethereum has been doing good. Well, actually, all time they've been doing good for me. Recently, you can see they're not doing very good. They're falling. If you look at the 5-year here, big dip there towards the end. And if we go to Bitcoin, just go to the 1 year here, you can see another massive dip. So they have fallen off quite a bit, quite dramatically. But again, I don't really invest into this portfolio much. I don't really touch my crypto account. But like we went through my TFSA, I do have crypto in my TFSA. I have those ETFs, which give me very, very good dividends. So now would be a really good time to kind of dollar cost average and bring my average price down by buying in this dip here that we see in crypto. Again, this was up to just about $10 like very recently, and now it's down to $7.22. So good buying opportunity for that. But again, I don't want to put too much into crypto. It's just another form of diversification, which again, I feel like I've said that a million times in this video, but it is worth reiterating. So I know that was very exhaustive and that took a while to get through, but that is because this is the first video that I'm making of my portfolio updates. I just kind of wanted to go through everything and kind of show you guys everything I'm invested into, all the accounts that I have, and just have complete transparency. I don't really want to leave anything out there on the table. I want you guys to be able to see everything that I'm doing. That way, you know that any of the advice that I give you guys, you can kind of trust that I'm not just, I'm not just talking the talk. I'm actually walking the walk. Like I'm doing the same things that I'm telling you guys to do, which I should say, none of this is financial advice. I'm not saying you should invest into any of these stocks. I'm just kind of giving it to you as a template and showing you this is what I've done. You can kind of take it from here and run with it. Do your own research, look at your own stocks, your own ETFs, research on some other videos, read some articles, but definitely get into the market, because as Warren Buffett, one of the greatest investors of all time, says, time in the market beats timing the market. Timing the market usually never works out, and people who try to time the market over the long term end up losing money, whereas people who prioritize having time in the market, meaning they just buy on a consistent basis, they don't try to time it when it drops, they actually make more money long term because they're in the market for longer. So just get in the market. If you don't know where to start, I would recommend starting with the S&P 500. It's probably the most safe and the most reliable, so start there. We're going to be going through many more videos of how to open up a Wealthsimple account, what these accounts actually mean, what is an ETF, what is a stock, what are the tax benefits of these different accounts, all the questions you have. We're going to do videos on all of them, as well as continue to give you weekly updates on my portfolio, which should be hopefully a lot quicker videos. Just kind of wanted to take a little bit of extra time to dive into the nitty gritty of every stock that I do own, so you guys can fully see everything. So that is where my portfolio stands right now. It's always a work in progress, but I hope being able to see the breakdown kind of gave you guys some insight and motivation into your own investing journey. So if you guys found that helpful, please like and subscribe. That helps me out a bunch. And I'm going to continue to give you guys weekly updates and educational videos to help you guys grow along with me as we kind of go down this journey together, one step at a time. And remember, it's not about when you start, it's just about starting. So please come along this journey with me. Thank you guys for watching. And until the next one, peace.